In this video, I just want to do a really brief analysis of the overall S&P 500 index today and how it traded and my interpretation of different kinds of setups and what was going on here in the context of what I know as a retail day trader. So to give you some background where we're at, we're in day 5 of the Russia invading Ukraine war. And there are a lot of sanctions about to hit Russia. They're talking about disconnecting Russia's central bank from the SWIFT system. And this has me really uneasy about the markets. I feel like there is a lot more downside risk right now than there is upside because of these news events that anything could happen in Ukraine. I mean, Russia could bring in nuclear weapons. We could get more players involved. It could turn into a bigger war. And on top of that, I think the financial sanctions will be damaging because there could be a contagion effect. This kind of reminds me of the 1997 banking crisis that occurred because of Russia defaulting on debts. And there was a currency crisis that happened, and that caused a big problem for the stock market, a big bear market or correction or whatever you want to call it back in 1997. Looks like I was wrong about that date. That was actually 1998 in July. The long-term capital management hedge fund blow-up happened, and the market was here, and then it dropped around 20% over the summer, but as you can see, it quickly recovered. But yeah, I'm kind of, I don't know if we're going to enter like a bear market because of the Russia thing, but certainly there's a risk of something like this happening, and that's kind of what I'm talking about today. And then we all know the 2008 Lehman Brothers blowing up. That kind of showed us how fragile the stock market really is when one bank blows up and they're over leveraged, and it causes a cascading effect. And given that businesses have a lot of exposure to Russia, Russia might owe them debts that can't be paid back. Russia might owe other governments debts that they can't pay back. And what happens to money that's owed to Russia, it creates some really interesting problems for the financial system. Let's look at what we got here. So it looks like there's kind of a support level here around the 427.95 area that the SPY is looking kind of heavy on. And intraday, I think this is the type of day where some news event could happen, and then you see everything that there. If the wrong type of news came out, this market could have gone way down and crashed. I mean, I remember seeing it when I was working at an investment bank in 2008, and just one afternoon, the entire screen turned red, and stocks that were close to $100 went down to the single digits. And I think something like that could happen in this type of environment again. But anyway, so let's see. Friday we closed up here, and then the market opened here a little bit lower, and luckily there wasn't a whole lot of panic. But it looked like, let's see, we'll zoom in here. And we'll go to the 2-minute chart. So it started climbing, reached the red to green area. So the close, this is called a red to green play. So it's down for the day, and then it's up for the day from the previous close. And usually if a stock could pass the red to green area, and this is a day trading sort of setup, sometimes it will continue on going through the green because of the fear of missing out. And the idea is that traders think that, oh, it's up, so it's safe to buy, or I want to get a piece of the upward momentum, and then so buyers pile in, and then it will continue going up. And if that happened, I probably would have expected to hit like 447 or so eventually. But instead, the red to green got rejected and tried to push through that. Unsuccessful, unsuccessful. So then you have traders giving up. And then that's when you start getting a lot of negative 1,000 ticks happening. Gosh, I wish there was a way that I could mark the positive or negative 1,000 ticks. That would be really interesting to see on this chart, how they're all clustered together. But this was a very active day. It's kind of unusual in that my phone was beeping with a lot of plus 1,000 tick alerts going in here, and then minus 1,000 tick alerts once we got past noon. And then rather than being like a complete sellout wipeout day where it goes to the lows of the day, it started getting a little bit of support here, and it zigzagged all the way down. Now, something that I notice happens a lot is this end of the day rally here that began at 340 or so. And you can see it right there. I think what's going on here is that the bears failed to push the stock price, the S&P 500 down further. And then so my guess is that a lot of people at this time period start covering their positions. And we probably had a lot of people who were short, who didn't want to be short going in tomorrow because it could open up big. You know, there could be big overnight news, and whoever's short didn't want to get caught holding S&P 500 futures or whatever on the short side and have this thing open at like 446 or something like that. So people unwind their positions, they close their shorts, and we go into the end of the day and it stabilizes. That's my hypothesis on how this works and how it's trading. There's a lot more that's probably going on behind the scenes and in different places, but that's generally what I think kind of helps make sense of some of these patterns that we see.